when we're really trying to become masters of our craft, and we have a tool set that's different, I think you guys know that, it's about how you use those tools and how you order the tools to accomplish whatever it is you're trying to accomplish. And I worry about this a little bit because of how we model what we do. And one of the reasons I worry about it is that, you know, you always hear me speak derisively of the trading education industry and trading in general because they tend to brainwash people into thinking things have to be done a certain way, and it's absolutely wrong. Well, you know, I also brainwash you. And you know, when I'm showing you something and I'm showing you charts, or Troy and I are talking about something in the room, or we focus on something, we're also giving you the impression, and we're giving you an impression, and you're taking that impression. So I'm concerned at times that, for instance, you know, we focus too much on, say, the stock indices in the room, and we do. Just a lot of things like that. So I want you to think about what we're doing and realize that we don't always cover all the bases. And sometimes we might be overemphasizing things at the expense of things that are just as important or even more important. So, you know, be careful about what we say and be a reality check for us. You know, by all means, I'm willing to be questioned, okay? I have 4 children, and they've all enjoyed Dr. Seuss, and I have thoroughly enjoyed Dr. Seuss, and there is an incredible amount of wisdom in those children's books. And one of my favorite books is from Beyond Zebra, and this is a quote from that book, Beyond Zebra. If you don't have it, I'd get online and I'd order it. It's really, it's a great metaphor for a lot of different things. And you know, one of my favorite things is I irritate my children to no end when they start questioning me and how smart they are versus me. I'll you know, recite this to them. But I think it's a great quote that basically summarizes, you know, before the term outside the box was ever coined in the business world, became one of those, you know, irritating terms that crops up all over the place. You had Dr. Seuss, who, without saying outside the box, wrote a book about it. And this was his book about outside the box. So I love this quote. So I want to go over a couple of things here that are within the basic guidelines, but maybe don't fit into hard, fast, binary rule sets. And that's the beauty of a discretionary trading methodology, and it speaks to that out-of-box concept. Now, one of the things that we really have not spent a whole lot of time on is the profile graph. And I want to talk about the profile graph for a few minutes because this is one of the things that I think about a lot that we probably don't spend enough time on. And I'm sort of talking out loud here, but that concerns me, but because the profile graph is very important. And the reason I don't spend that much time on it, and Troy doesn't spend that much time on it, is because we both, when we look at a bar chart, we see a profile graph. When someone comes to us, comes to Alexander Trading, they usually come to us because they want to learn market profile. And then when I pull up a bar chart, or Troy pulls up a bar chart and he starts talking about high volume nodes and this, that, and the other, you're sitting there scratching your head going, what the hell are they talking about? This isn't market profile. But again, we're not market profile traders, but that market profile graph is a very useful tool. So let's just take a look at some of the things, and I'm going to share it with you, that I look at, and I do. I mean, I look at a profile graph all the time. Now, this is crude, all right? But this could be anything. And one of the huge benefits of looking at the profile graph is that it's a noise filter. You can really see what the auction is doing, and the auction is about market participation. what the participants in the market are doing, where they're doing it, how much they're doing it. I mean, that's what we're looking to see. So if I look at crude here, I can very quickly look and say, all right, now this is an area down here that's been rejected. I've got, I've got buying tails here. They tried to build some value down in here. They couldn't take it lower. They couldn't take it lower here. And then to the upside, I have this area in here. I've got a high volume node from this most recent structure and then this level. So I can look at crude in this chart and I can define sort of my gross extremes very quickly. And from an auction market perspective, I just gave you why. I told you everything about these levels that make them important. And so if I look at this now, I can go down in time frame and say, okay, well, this was yesterday's structure. Now this is a 24-hour structure. So that's my level. And then I have the high volume node down here. Now I can mark these levels on a chart, bar chart, and be aware of them. Now if I go to a bar chart, I can see this. I can certainly see the high from yesterday, but you just get a different perspective when you're looking at a profile chart. And if you go back and pick any contract you want to look at, and I'll do this periodically, I'll go back and I'll just sort of scroll through just to get a feel, get a feel for the market. What's going on here? Well, I can sort of see value migrating here, and then it becomes two-sided in here. And look, this is a pretty two-sided market in here. So the bigger structure here is, we're sort of two-sided. Now, why is that important? Well, we were migrating higher, but we seem to have stalled, and we're building a bigger auction. So the potential is for maybe a sharper move is in the near future. Now, the other thing you'll notice when you do this little exercise, you'll notice how often a day or two's previous lows and highs are important key reference areas. Now, true, on the 11th, you took out this high by a little bit, but it left a big old selling tail here. I mean, this was probably a trade opportunity. Likewise, this market traded down into the unfair lows from the previous day and formed a bottom. You've heard me say the previous day or two's extremes are always key reference areas. That's trade location. That's potential trade location for you. It's very easy to look at a profile chart and to see these areas. And part of the reason is this on a bar chart, this is just a bar and this is just a bar. You don't have the development that sort of separates things out so that you can really identify these areas. At least for me, it's just easier for me visually sometimes to view the previous day's highs and lows in a pattern on a profile chart than it is on a bar chart. Let's see. But I don't think you can go through any commodity or futures contract and not find within I don't think you can go more than 4 or 5 days, even if that market is trending stronger, where you didn't have a market that traded within the range of the previous day's extremes, upper and or lower, that would have given you an opportunity, if you were aware of what was going on at that point in time, for good trade. Now let's look at, say, the S&P. Now in the stock index futures, now this is an individual day. As you guys know, I will divide these out into the session profiles, and I'm really irritated with this new little session that they've created, I'm sure for the institutions for some reason. But you can see here, here's a perfect example. Of course, this is all the recent trading. Here are those recent highs. Here's a series of lows in here. And, I've done this for thousands of days over, my career of trading, just doing this, going through and just scrolling through and looking and noticing. And I tell you, as far as the stock index futures are concerned, I can't think of a better exercise to identify trade opportunity than what I'm doing right now. And all it does, this is past history. You can't trade this. But what it does, it reinforces the fact that this occurs over and over and over. I don't know if the S&P is going to 2,000 or if it's going to 1,000 from here. But it really doesn't matter, because along the way, you're going to see this. You're going to have opportunities like this. As a matter of fact, just for an exercise, okay, let's kind of scroll through this special period of time. I'm going to start over here. Okay, in this particular special period of time, this is the month of September. And here we had a market. Here's some highs. And here's some very important lows. And the market traded lower. Now, this was a Globex session. And then you had a bounce here. And you had, you had highs in a similar area here. And then you had lows in a similar area here. And then you had a bounce here, and this bounce occurred into, I'll bet you, a high volume node, didn't it? How about that? What a coincidence, right? It's amazing. And then this market, at this point in time, began to trade lower. And once again, it traded lower, and then it bounced, and it formed a high on this day. It was tested in Globex, and then the next trading day, you came up and you tested this area. You formed a selling tail. You traded lower. And then you traded lower in here. You formed a series of lows. You formed a minor high volume node here. Traded lower again. And sort of the bottoms went up. What I'm trying to find here, I'm just trying to find times where this market in this time frame had a series of relatively close highs and lows. Here was another series in here, similar highs and similar lows. Traded lower, formed similar highs, similar lows. Now, you can see this is very, very sophisticated analysis, right? But if you didn't do anything but this, trading the stock index futures, it would put you ahead of what everybody else does. And this, you probably can tell, but this was the December 2008 S&P contract. This was the fat part of that decline that occurred. So here's a 120-minute chart. Now, the reason it's so difficult for anybody to make money trading stock index futures is because they really don't understand the market. And what they want to do, they want to sell it. And the next time we have a decline, this is why they won't make money. They want to sell this, and then they just want to sit on it and close their eyes and think it's never going to come back. Or what they'll do is they'll micromanage it, and they'll micromanage themselves out of the trade all the way down. But you've got these opportunities here where these key reference areas form in an area. The auction process is in effect in all degrees of time, all the time. And if you're patient, just because you miss this, you're going to get another shot. The odds are overwhelming you'll get another shot. and this is true in any market. So that's how I will, that's a way, another way you can use a profile graph. Now, another way I'll use a profile graph, you guys have seen me do this too. I'll take, for instance, let's just take this day. Whoops. I'm sorry. There's no getting around this. I picked a day in the middle of the series. Now I can't find it. All right, let me do this. I'll start over. Sorry, guys. But this is something I do want to show you, so I'm going to spend the time to do it. Okay, let's make it simple. We'll take this one. Okay, now, I said before the profile graph is a noise filter, and the auction process is in effect in all degrees of time all the time. Now, what I've done is I've taken this day, and I have taken each 30-minute rotation, and I've made basically a 5-minute profile out of it so that each slot, there's 6 slots per time period here, and I have the auction within the 30-minute time periods. And it gives me a view of things that helps me filter the noise. Another good example of it is probably today. Let's just take a look. Because today was really noisy. The end of the day. Let's just see. I split this out. Well, in this particular instance, it's not particularly illuminating, or would not have been, because the market went nowhere in here. Now, I will say this: if you had seen this view coming into, I guess this was the Fed announcement, you would clearly have known that everything was going on between here and here, and unless you traded outside this range, you really, it was just random. It was totally random in here. Now, obviously, when this market attempted to break out, when it traded back through this high volume node here, that was a sell signal. If you were willing to take it overnight, and you get back into the time factor again. But the point of this is that I'm showing you different ways to use the profile graph outside of a rote application. And by no stretch of the imagination do I think I have a license on all the ways to use the profile graph. But I'm going to make an effort to start highlighting the profile graph more and how to use it, because it really is a valuable tool. It's not magic. I think, I've made that point very, very clear. But if you view it through the lens of this auction process, it is a fantastic tool. And if you're consistent with viewing your markets through the profile graph, I think you will pick up information that you're not going to pick up on a bar chart. Now, obviously, on a bar chart, you'll pick up information you're not going to pick up on a profile chart. And an example of that is if I'm sitting here and I'm looking at this chart, okay, I'm watching this, and I see this market is, in this time frame, this is a mature balance area, right? So what I'm looking for, what I want to catch is I want to catch initiative activity. Well, the better view to catch initiative activity is to go to a bar chart. And so the first clue that there might be something going on really was in here, and then I had this conviction of this bar. So if this is my high volume node, and I think, and this is an initiative trade breaking out of this time frame, and I have this bar here, I can go long. I could go long on a stop, or I could just go long right here and put my stop here, right? So that's a way you can, and it's really the best way to analyze a market. This way you're integrating your profile chart, and you're using the profile chart as a reality check to show you exactly what's going on. The market is building balance. And then when that balance area in the time frame you're trading begins to mature, then you can go to your 5-minute chart and understand what's been going on here. It's a lot of chop, but it's balance. It's trade facilitation. The market is on hold, and it's going, it's going to move. And then when you see your conviction, then you can take the trade if you choose to take the trade. And that beats trying to guess in here before this happens. Because if you go long in here and you put a stop below here, you get stopped out, right? Or you get nervous and you get juked out. So, this is trading market condition, but it's also using the structure of the market. And it's also using time. I have a much higher probability trade. Let me erase this. I have a much higher probability trade in this area time-wise than I do over here. Much higher. Particularly in light of the backdrop in which this day is trading, the Fed meeting. So that's a little look outside the box of a profile graph. It's a noise filter, helps to highlight time variable of the trade. Okay, here are a few other things to consider. We encourage you not to trade one contract in one time frame. So consider the whole array of trading vehicles. You are a trader. You are not a futures trader, a commodity trader, an options trader, a stock trader, an S&P mini trader, or a day trader. You are a trader. Be a trader. Don't confine yourself by a definition that the industry has of trading. If you're a trader, trade. Find a vehicle that fits you and what you're trying to accomplish. Maybe you don't have an account size large enough to trade the big contract in crude. Well, maybe you can trade the mini contract in crude. Maybe you can trade the micro contract in gold. If you have a retirement account, begin to swing trade ETFs in your retirement account. You can buy 100 shares of, an S&P, 2 beta proxy up or down, or the ETF, the commodity ETFs. Learn how to use options. And then in a minute, we're going to talk about Forex, which I think is a wonderful route. And that's something else we're going to be getting more into at Alexander Trading too going forward. But these are all things that can help you. I mentioned that I was going to, and this was supposed to be in a previous session, how to add alpha to a large account. Here's how you add alpha to larger accounts. You don't have to sit there and day trade the S&P Mini in your 401k. You can, I do, but you can do it a number of different ways using these concepts and by using the different trading vehicles that are available. I trade my wife's retirement account, and I can't trade futures in it, which is probably a good thing for my marriage. But I trade ETFs. I trade the ETF proxies in her account very actively. I can trade gold. I can trade the S&P long, short. I can trade copper. I can trade grains, energy, all by using different instruments. Now, here are some of the things that are tradable, and I'm going to show you some examples of them. But the grains have mini contracts. The currencies have mini contracts. Gold and silver have mini contracts and micro contracts, and crude has mini contracts. There are other mini and micro contracts, but a lot of them don't have enough liquidity, in my mind, even to swing trade. Now, these are vehicles that are not suited for trading on a 5-minute chart. You can day trade the mini crude contract. You can day trade the mini gold and silver contracts. You could probably day trade natural gas. Natural gas, that mini contract is probably, natural gas is becoming quite the topic these days. And if you have, if you're interested in trading natural gas because of this, that, or the other, a great way to trade it, a kinder, gentler way to trade it is with these mini contracts. And you can do really well trading these smaller contracts. And another benefit of these contracts is, or more benefits are, that you can swing trade them. If you have a $10,000 account, even trading corn, which is typically not thought of as a particularly volatile contract, well, it depends on when you're trading corn, right? If you're trading it last summer, and you have a $10,000 account, that's a lot of exposure. That's a lot of leverage exposure for the volatility. But if you trade a mini contract, you can do that, and you're not over leveraging yourself. Okay, now this is a 60-minute contract of May corn, and let's go to a daily chart. Now this contract is going to look exactly like, hold on, let me do this real quick. All right, here's your big contract. And if we look at the specs, you can see the value of this, the tick value is $12.50, like an S&P Mini, and from 731 to 732 is $50. Now, if we look at the mini contract, the tick value is $1.25. So it's $5. It's very small. But it allows you, if you're trading this contract, to put on a position and to live with it. But you're not going to make any money day trading mini corn, mini beans, etc. But it might give you the opportunity if you take a position. Let's say hypothetically, you're trading corn, and I've been talking about favoring the long side of corn. And you're saying, well, yeah, but I don't want to get stopped out. It's too much money. And let's say corn closes here, and it leaves a potential selling tail. Well, you can put a contract on, and you can risk $112, $13. And now you can stay with this contract. And at this point in time, if you'd entered here, you'd have $220. You'd have almost 2-to-1 in your trade. You could raise your stop up to here. And you can sleep at night, and you can give it a chance to work. Last summer, let me see if I can let's see, that would be interesting. Okay, here's last summer. This is the July contract. So let's just take a hypothetical and say, you had this balance area that formed down there, and then you had this conviction. Well, if you take a position in the big contract, had taken a position, hold on. All right, right here, when you had all this conviction, if you bought it to close, well, that's $1,500 a contract. If you've taken a position here, well, it's more manageable, certainly. It's $366 a contract. But you're more likely, the newer trader is more likely to take a position here. And this is reasonable in a situation like this. And then you eventually end up with 5 times easily. I mean, you had an ample opportunity to get out with almost 5 times your reward to risk here. So the point of this is that don't ignore, and I trade these things sometimes. So I'm not, just because you have, a $500,000 account or $1 million account doesn't mean there's no place for this in your portfolio. I'm doing 7 million things every single day. I miss so many opportunities. I trade stuff like this because I can put it on and I don't have to worry about it. It's on. If it works, great. If it doesn't, I'm not going to lose that much money. But it gives me a chance to participate. Oh, wait. This is the one I wanted to show. All right, so that's corn. Let's look at some of these others that are in here that are viable. Let's look at crude. All right, here's crude. Now, this is a 60-minute chart, and this is the present contract. Now, this is, there's plenty of juice in the mini crude contract. It's $500 a point. So, for instance, if I were to have sold crude here and I put my stop here, well, that's still, that's less than $100 a contract. Why bother, right? Well, here's why bother. It's almost 9-to-1 reward to risk. Now, a lot of you have no business trading the big contract in crude. And I say that because, we have different levels of experience, we have different account sizes, but I don't think there's anybody in this course that can't afford to take legitimate good setups using the mini crude intraday. Here's another one. If this is a balance area that formed, I've gone through the number of ways you can enter a balance area. You could enter it on the break here with a stop above here. You've got $137 risk, and it ends up going down. That's a little bit more than 2-to-1, but that's a good day trade in crude. So don't. Think about using these things. I don't care how large your account is. Let me find. Oh, okay. Here's gold. Okay, this is micro gold. This is 1/10 the size of gold. Now there's a mini gold, and I'll show you that one in a minute. But this is micro. So if I think gold is topping here and I want to sell it and be able to sleep, I can put a position on here. I can put my stop up here, and I'm risking $210. And, if I'm selling gold here, my target is where? It's to here below, right? So I have the opportunity, that's not quite 2-to-1, but quite frankly, if I'm selling gold, the potential, I think, if this fails up here, I think you're going to tear this up to the downside. So, but this shows you you've got a reasonable, and this is a daily chart, and this is a long way away from this high. Let's go to a 120-minute chart and probably do better risk-wise looking at it that way realistically. Okay, here we go. So if my stop is here and I enter here, that's a little less than $200 risk. That's very reasonable, and you've got the potential for the position to go, you know, a multiple of your risk. Now let's drill down further, and if I'm trading on a 30-minute chart, and I see gold spike up in here, and I sell it. Now this is 30 minutes, and the better view of this. Let me do this. All right, here's the big contract. No, I thought it was. Now, that's what I wanted. Okay, this is a better view. So this is a 30-minute chart. This is the big contract. So if I'm looking at the big contract, now what time was this? Yeah, was this afternoon? I think it was. Let's pretend this was this afternoon, even if it wasn't, for the sake of argument. And we came up here, and we've got a selling tail here. We've got a selling tail here, and I'm looking at it, and I go, you know, I think I'd like to trade this, but I can't afford it. Well, I can look at this, and I have a level over here, and then I know if this is going to work, this shouldn't be taken out. So here's my stop. Well, in the big contract, that's going to be $360. That's not unusual in gold. But if I have a small account, I can't afford the risk. I don't care what the return is. So if I go over here, now this level is 16, let's call it 1612. So if I find 1612 over here, that's 1611. All right, here's 1612. That's the wrong thing, sorry. $16.12, just above here. That's $40. Anybody that has any business trading can afford to take this trade. And you know, the potential again is to down here. So that's a 10, better than a 10-to-1 potential reward. Trading this contract exactly the way you see Troy trade gold in the room. Exact same setup. You're just using a different vehicle to trade it. Yeah, and you know, Sean brings up a good point here. He finds the minis useful for taking multiple contracts where otherwise I could not, especially gold and crude. Now the mini contract, and this is 1/3 the size of the big, so it you know, it has some juice in it that has to be respected. So if I take my trade in the mini in here at what did I say, 612, and my stops here in this contract, yeah, it's still, you know, it's $106. Yeah, most of you can afford to do that. So any questions about these contracts or what I'm discussing here? There's no difference in the way you trade these. I don't want you trading them differently, except you have to expand your time frame, which you should be doing anyway. It's a positive thing. Even if you're trading the big contract, if you can eventually get to the point where you're trading just 30-minute charts, you're going to be better off. James, if you're trying to ask me a question, send it to all participants. Okay, here we go. Thank you. So the stop is just below the very peak of the HVN or just below the impulse bar. What if the impulse bar was above the HVN? Which particular contract are you talking about, James? But you know, just in general, if I read that correctly, if there is a bar of conviction, that supersedes the high volume node, and I would put it just above or just below the volume of the conviction. Do the mini and micro contracts really reflect the same reality as the full contracts? They have to. Otherwise, arbitrage would snap them back in line. Why wouldn't they? They're going to be a little bit thinner, but they're not, you know, if gold rallies $10 or drops $10, I promise you that micro contract is not just going to sit there. Yeah, the spreads are definitely going to be wider. There's no question about it. But if you're trading, you know, the minis or the micros, you know, you're trading for a minimum a day's range. I mean, you can enter on a 30-minute chart, but you're really trading that daily structure. You know, they're not meant for day trading, but that's okay. James, did I hit all your questions? Evidently, you were typing them into an area that I didn't see them. Okay, but have I hit everything, James, that you wanted discussed? Okay, super. Okay. Let me scroll down here. Okay, the other thing that I would suggest that you do is to begin to learn something about options. And options can be fantastic trading instruments, and they're almost always misused. Hold on, Chris, you came back with a question about the E-mini volume is like 10 times the full. Is that not true? No, Chris, it's not even close. Here, I'll give you an example. No, in these other contracts, there's nothing that comes close to the experience we have with. Let me give you an example here real quick. Okay, here's mini-size gold. Now this is, you know, there's 6,000 contracts traded here. Here's silver, 3,185. But some of these that are still tradable. Let me find the grains. See the? Wait a minute, I'll show you. CBOT, here we go. All right, let's see. Okay, here we go. All right, here's the mini corn, 1,100 contracts. Now, you don't want to be day trading mini corn, but that's big enough to swing trade, position trade. Here's wheat, even 475 contracts. You can position, swing trade that. Let's see. Where beans, see where they are. And of course, this is going to vary with the present market. I guarantee you last summer, you probably had 2,000 or 3,000 mini soybeans traded every day. This is 800. But the point of this is, to answer your question, no, you're never going to get the type of volume you have like in the S&P Mini. And the volume will vary along with the interest in the contract and what's going on. But the contracts that I'm showing you guys and that I have listed on these slides, and you'll have the slides, there's enough volume in there that you can trade them. Even the micro gold, I can't remember, where's the micro gold trade? Well, here, I'll find out. I've got to find where I had that micro gold contract. I think this is the symbol. Let's just try it. Yes. Okay, let's see where it's traded. Okay, it's COMEX, so all right, here's a, no, that's copper. Copper's a little thin, but it's, if you're going to swing position trade it, it's tradable too. Where's micro gold? Here it is. Okay, 995 contracts. That's fine. That's enough. All right, here's mini copper. That's 73. That's getting down there. You got to be careful. 73 contracts, you could become the market pretty quickly. But micro gold, 995 contracts. That's enough. Okay, we're going to talk about Forex. Now, Forex offers a tremendous opportunity for smaller accounts. And the reason is that you can sort of dial your own risk. You can pick your own notional value in Forex. Do any of you guys trade Forex? Have any of you traded Forex? You have, James? Mike? It's a great contract to trade. I've started trading it, just playing around with it, because I'm going to expand into Forex with what we're doing for a number of reasons. Number one, there are a ton of people trade Forex, but number two, I think it offers an incredible opportunity to train people to trade on something they can actually afford to trade with real money and not get hurt. Well, or less likely to get hurt. Got to be careful with that one. You can hurt yourself trading anything. Okay, let's look at this. But it's uncanny. Get rid of some of this. Okay, this is the euro. Now this is the Forex cash contract. This is a 60-minute chart. And this is the futures contract right here. Let's see if I can line these up a little better. Now the cool thing about these contracts, the Forex, first of all, they basically trade 24/7, 365. But in the euro, my tick value is static, right? So I'm paying $12.50 per tick. I can trade this contract, and I can have $2 a tick, $5 a tick, $10 a tick, and I'm going to show you a little bit about what I'm talking about here. Let's see. Now this is the Interactive Brokers. One of my accounts is with Interactive Brokers, and this is their Forex trading platform. So if I want to say sell the euro, I click sell, and then quantity, I can dial up my own quantity. This is $20,000 of notional value. That's roughly a fifth or sixth the size per pip or tick of the futures contract. So now I can, first of all, I can trade in larger degree time frames, and that's always an advantage because remember, the more granular you go with your trading, the more random your results are going to be. That's just a fact. So I can afford to trade the euro on a 30-minute chart, a 60-minute chart, even a daily chart, and I can control my risk here by designating how much I want my risk to be. I can go up to $100,000. I can go 5 times this risk. I can go down to a $10,000 notional value, which is, just sub-micro almost. And I like the Interactive Brokers platform. And guys, I do not have experience with all the Forex platforms that are out there. And it's a minefield, and be careful. I know for a fact that there are guys that are currency pros that we have as clients that like Interactive Brokers because you're paying a commission, you're not paying a spread. And the spreads, which is a real issue with trading these contracts, depending on where you trade them, the spreads are as tight with Interactive Brokers as anywhere. So, if you're going to begin experimenting with Forex and you haven't before, Interactive Brokers is a great place to do it. You're paying a fixed commission. They don't play games with the spreads. You can still dial in your risk, and you're still trading. I mean, this is the platform, but you're trading exactly what we trade. And you're trading it the exact same way. Now, this is a Forex chart. This is the euro dollar. Here are the profiles. It's the exact same contract. All the guidelines, all the rules. It's an auction market. So this type of thing can be very helpful for some of you that, and it's a great day trading vehicle. I mean, the currencies are wonderful vehicles. And another thing about the currencies is that you can trade currencies that are not listed. Like you can trade the Euro-Japanese cross. You can trade the Australian-Japanese cross. I think I have that up here. No, I don't. But that's a big contract right now because of the carry trade thing. Here's the Euro-British pound. That's an interesting contract right now. So you can trade these macroeconomic events that you might not get good exposure to with the contracts we trade. You get a pure play by trading some of these crosses this way. Chris's comment is, I thought futures was a better way because of the spread in Forex. It used to be, and it wasn't even close. Now, in some of that had to do, Chris, with the fact that you get these guys that over leverage themselves, and so the spread makes a difference because they're trading in just ridiculously short-term time frames. If you're trading the way we're trading, the spread on any currency pair, that that you have any business trading is not an issue. Chip, you asked, do I ever trade spreads, unleaded, heat, calendar spreads? The short answer is no, I have not. But that's a great way to trade, and I have clients that do that. You guys see Headley's comment here? That's not much, is it, Michael? So all of these things are more things for you to think about, and thinking is good. Questions? Yeah, Michael, the CME, has shot themselves in the foot so many times, so many ways. It's amazing, but that's a topic for another time. When I'm in Chicago, you and I'll go have a drink, and we'll talk about it. Algo, you're going to have to help me with that. I need a little more information, Chris. Sorry, it's late. I'm not as sharp at 10:30 as I am maybe at 8 a.m. I'm still missing something. Algo on currencies. I'm sure, listen, but you're still going to have algorithms in there. And if you trade the way we trade, I'm not going to say it doesn't matter, but it's still an auction market. Now, I want you guys to continue while I'm talking here. If you have questions about anything under the sun, I want you to let me know. But when I first, in session 1, I told you as an unlisted bonus, one of the things that I offer to do at the end of this, for those of you that have kept your trade records, I will spend a session with you, and we will go over your trades in detail, and we will discuss your trades, and I'll give you some comments, and I'll give you some things to work on, and maybe some exercises. So if you have done that, send me your trades, and I will contact you. We will set up a time, and one evening after the market closes. We'll take as long as it takes, and we will review your trades and discuss things. Now, I really, really, really want you to have a chance to do this. So there's no way I can do this with I know there's several people that have done it. So it will take me a matter of 2 or 3 weeks to do it. If you haven't been keeping your trades, at least keep your trades for a week, and I'll still do it because I really want you guys to avail yourself of this. Ed, I'm not aware. I think even the currency shut down for a period, and I'll have to look into that. I don't know all the trading hours of the Forex markets. So guys, again, if I'm giving you another chance, if you'll keep your trade records for a week and do the thing, go back and look at session 1. I outlined what I want to see. Then I'll spend some time with you one-on-one. Questions? All right, now I'm going to stop the recording in just a second, but I want you to hang around because I have a couple of things I want to ask you about, okay? But this is going to complete the initial presentation of our Foundations course. And you guys are the initial attendees of this course. And as long as you are an Alexander Trading member, the next time I give it live, and I will do it again within the next 12 months, I will hope that you will avail yourself of the opportunity you have to come back It's included in the fee that you paid to see it the first time. As long as you're an Alexander Trading member, you can watch it the next 10 times I do it. If you're an Alexander Trading member and you don't want to watch it, you just want the recordings, you'll get the recordings. So that's another benefit to you. You know, you're the first guys through, but as long as you're an Alexander Trading member, you will see future iterations of this, and it will change every time I do it. There will be, it won't change, everything you see will be here, but there's always additional information. Things are emphasized that weren't emphasized before just because of the dynamic of doing it, quote unquote, live in front of a group, and how the questions direct the flow of the direction we take sometimes with emphasis. So with that, I'm gonna stop the recording. I want to thank all of you, and then I've got a couple of comments here. I want to have a discussion with you when I stop this, so hang in.